Imagine two men living in the same upscale neighborhood. On paper, they appear to share the exact same level of financial success. They both drive elegant vehicles. Their children attend the same private academy. They live in identical houses valued at $3 million each. But beneath the surface, these two men exist in completely different financial universes. The first man is Julian. Julian is a highly skilled corporate executive. He spent decades climbing the corporate ladder. Today, he earns an impressive salary of $600,000 per year. He is proud of his high income. Yet, every single month, Julian feels an invisible weight crushing his financial progress. When his paycheck arrives, the government immediately takes its share. Between federal income taxes, state taxes, and payroll taxes, his effective tax rate sits at over 50%. Julian is trapped in the highest tax bracket. To fund his lifestyle and save for the future, he must work harder, earn more, and watch more than half of his effort vanish before it ever touches his bank account. The second man is Marcus. Marcus is a quiet business owner who runs a commercial ventilation supply company. His business is highly profitable, but Marcus does not pay himself a massive salary. In fact, his official salary is only $50,000 a year. On paper, Marcus looks like a middle-class citizen. He appears to earn less than a retail manager. Yet, Marcus controls a financial portfolio worth over $10 million. He travels frequently. He invests in private equity. He purchases valuable commercial real estate. Most astonishing of all, Marcus pays almost $0 in federal income tax. This is not a story of illegal tax evasion. This is a story of legal financial engineering. Julian plays by the rules designed for the working class. Marcus plays by the rules designed for the asset class. To understand how Marcus achieves this, we must examine a hidden financial machine. This machine is known by the elite as the buy, borrow, and die strategy. It is the primary mechanism used by quiet millionaires to accumulate massive wealth, enjoy high liquidity, and legally bypass the tax system entirely. To understand this secret system, we must first dissect the fundamental flaw of earned income. The United States tax code is structured as a progressive system. It is designed to tax movement, not stagnation. When money flows from an employer to an employee, it is classified as active, earned income. This is the most heavily taxed form of wealth on earth. For someone like Julian, every dollar earned over $80,000 is taxed at progressively higher rates, peaking at 37% at the federal level alone. When we add state taxes, Julian loses nearly 45 cents of every single dollar he makes. This creates a severe compounding drag. Julian must earn $2 just to invest $1 back into his future. The wealthy do not build their lives around active flow. They build their lives around static asset accumulation. This is the first step of the strategy buy. When Marcus acquires assets, he is not seeking a high active income. Instead, he focuses on purchasing appreciating, cash-flowing assets through corporate holding entities. These assets include commercial real estate, multifamily apartments, and diversified equity index funds like the S&P 500. When these assets increase in value, Marcus experiences a phenomenon known as unrealized capital gains. If Marcus buys a commercial building for $1 million and its value rises to $2 million, Marcus has gained $1 million in wealth. But under current tax laws, this gain is completely invisible to the Internal Revenue Service. The government only taxes realized gains. A gain is only realized when an asset is sold. Because Marcus does not sell his building, he pays $0 in tax on that $1 million increase in his net worth. His wealth compounds in silence, completely shielded from the friction of annual taxation. But this creates a massive practical problem. If all of your wealth is locked inside of appreciating assets, how do you pay for your daily life? How do you buy a new car, pay for private tuition, or purchase another investment property without selling your assets and triggering a massive tax bill? If Marcus sells his shares or his real estate to get cash, he will trigger a capital gains tax of up to 20% federally, plus state taxes. The very act of converting his wealth into cash would destroy a massive portion of his compounding machine. This is where the second step of the loop comes into play: borrow. This is the core engine of the stealth wealth system. The average person is taught that debt is a dangerous trap. We are told to pay off our mortgages quickly and avoid loans. But to the financially elite, debt is not a burden. Debt is a powerful, tax-free financial tool. Under the United States tax code, borrowing money is not considered a taxable event. When you take out a loan, The Internal Revenue Service does not view that cash as income. Why? Because you have an obligation to pay it back. There is no net gain in wealth. You are merely exchanging an asset for a corresponding liability. Therefore, no tax is levied on the borrowed capital. This is the mechanism Marcus utilizes. Instead of selling his $3 million stock portfolio, Marcus approaches an investment bank. He requests a specialized financial instrument called a securities-backed line of credit. The bank reviews his portfolio of highly liquid equities. Because his portfolio is diversified, the bank is more than happy to extend a line of credit using his stocks as collateral. The bank offers him a credit line of up to 70% of his portfolio value. In this case, Marcus receives access to over $2 million in cash. The interest rate on this credit line is highly competitive, often tied to a benchmark like the secured overnight financing rate, plus a small premium. Marcus can draw from this line of credit whenever he needs liquidity. He uses this cash to fund his lifestyle, buy real estate, or invest in new businesses. Meanwhile, his original $3 million stock portfolio remains fully invested, compounding in silence at an average rate of 8% per year. This massive growth completely outpaces the low interest rate on his loan. This creates a state of permanent capital expansion, allowing Marcus to build his lifestyle using a tax-efficient cash strategy. At first glance, this approach might seem incredibly risky to the average investor. We are conditioned to view debt as an anchor, a financial danger that must be eliminated as quickly as possible. When Julian buys a car, he uses his hard-earned cash or takes out a traditional amortizing loan. This traditional loan requires him to pay back both principal and interest every single month. This directly drains his monthly cash flow, forcing him to work even harder to maintain his lifestyle. But the debt Marcus utilizes behaves in a completely different way. A securities-backed line of credit is a non-amortizing loan. This means there are no mandatory monthly payments toward the principal balance. Marcus is only required to pay the interest on the money he actually draws down. If he draws nothing, he pays nothing. If he draws $100,000, he only pays the interest on that specific amount. Because there are no amortization schedules, the principal balance can remain unpaid for years or even decades, while his underlying assets continue to appreciate in value. To fully comprehend the genius of this strategy, we must look at the mathematical arbitrage. Let us assume the interest rate on the credit line is 6%. Meanwhile, his $3 million stock portfolio has historically compounded at an average of 8% per year. This 2% difference is called positive arbitrage. If his portfolio grows by $240,000 in a single year, and he borrows $50,000 at 6% interest, his asset growth still massively exceeds his cost of borrowing. He has created a self-compounding machine that pays for his lifestyle without shrinking his core wealth. Now let us look at Julian's math. To spend $50,000 on a luxury purchase, Julian cannot simply draw from a loan. He must earn the money. Because he is in the 50% tax bracket, he must earn exactly $100,000 in active salary. The government immediately takes $50,000. Julian is left with the remaining $50,000. To fund his purchase, Julian has had to surrender $50,000 of his labor to the state. Marcus, on the other hand, spent $0 in taxes to access the exact same amount of cash. But the system gets even more favorable. In the United States, there is a powerful legal provision known as Section 163D of the Internal Revenue Code. This section governs the deductibility of investment interest expense. If Marcus uses his borrowed money to buy more investments, such as acquiring a rental property, purchasing commercial real estate, or acquiring shares in another profitable business, the interest he pays on his securities-backed line of credit is completely tax-deductible. The cost of his debt offsets his other investment income, reducing his tax liability even further. Of course, this strategy is not without potential hazards. The most prominent risk of using a securities-backed line of credit is the dreaded collateral call, commonly known as a margin call. When you pledge your stock portfolio as collateral, the bank monitors the value of your assets daily. If the stock market experiences a sudden, severe crash, the total value of Marcus's $3 million portfolio could drop significantly. If the value drops below a certain threshold, the bank has the legal right to demand immediate repayment of the loan or sell his shares to cover the debt. This is why quiet millionaires never utilize the maximum loan limit. The bank may offer Marcus up to 70% of his portfolio value, which is $2,100,000. But Marcus is highly disciplined. He manages his loan-to-value ratio with extreme precision. He never allows his outstanding loan balance to exceed 25% of his total portfolio. By keeping his debt at only $750,000, Marcus creates a massive financial buffer. The market would have to decline by over 60% before the bank would ever issue a collateral call. Furthermore, Marcus does not just rely on stock portfolios. His business, the commercial ventilation supply company, continues to generate consistent revenue. If a market downturn occurs, Marcus can easily redirect some of his business cash flow to pay down his line of credit. This multi-layered approach completely insulates him from the volatile swings of the public equity markets. He has decoupled his personal consumption from his personal income, meaning he is never forced to sell assets during a market crash. To make this system even more robust, Marcus does not hold these assets in his personal name. Instead, he utilizes a sophisticated holding company structure. Marcus established a Wyoming limited liability company. This entity acts as the central vault for his assets. The Wyoming limited liability company owns his commercial real estate and his stock portfolios. This holding company is then owned by an asset protection trust. By layering these legal entities, Marcus achieves absolute anonymity and unmatched legal protection. Now let us examine Julian's structural vulnerability. Julian holds all of his assets, his home, his savings accounts, and his brokerage accounts, in his personal name. This means his wealth is completely exposed to the public. If Julian is involved in a major lawsuit, perhaps a car accident or a professional liability claim, a motivated attorney can easily search public records. They can identify his assets, freeze his accounts, and seize his hard-earned savings. Julian has spent decades working 80 hours a week, yet his entire financial existence can be wiped out in a single legal battle. Marcus operates in an entirely different legal reality. Because his assets are owned by a Wyoming limited liability company, he is protected by some of the strongest corporate laws in the United States. In Wyoming, the sole legal remedy for a creditor seeking assets from a limited liability company is a charging order. This means a creditor cannot seize the company assets, cannot force Marcus to sell his shares, and cannot interfere with the operations of the business. The creditor is merely entitled to company distributions, which Marcus can simply choose to never make. By withholding company distributions, Marcus leaves the creditor holding a useless legal document. The creditor receives $0, while Marcus continues to manage his assets in peace. This represents the ultimate integration of tax efficiency and asset protection. But this is merely the defensive shield. To fully appreciate this hidden financial machine, we must next examine how Marcus uses his corporate business to wipe out his taxes. To understand how Marcus eliminates the tax burden on his operational business, we must look at the structural division of cash flow. Most people believe that owning a business automatically makes you wealthy. But if a business owner structures their company poorly, they will end up paying even more taxes than a highly compensated corporate employee like Julian. If Marcus simply withdrew all of the company profits as personal salary, he would face the exact same progressive tax trap. He would be hit with personal income taxes, state taxes, and self-employment taxes, losing more than half of his business earnings to the government. Instead, Marcus structures his commercial ventilation supply company as a corporation. In the United States, corporate tax rules are fundamentally different from personal tax rules. A personal taxpayer is taxed on their gross earned income and is only allowed to spend what remains. A corporation, however, is taxed on its net profit. This means the corporation can earn revenue, spend money on legitimate business expenses, and only pay tax on the residual amount left over. Marcus uses this legal distinction to convert his personal expenses into legitimate corporate deductions. Consider how Julian and Marcus handle their daily lives. Julian must pay for his mobile phone, his internet connection, his computer, and his automobile using after-tax dollars. To pay a $2,000 monthly automobile lease, Julian must earn $4,000 of gross active income, since half is immediately claimed by taxes. Marcus, on the other hand, operates his automobile as a company vehicle. His commercial ventilation business leases the vehicle directly. The mobile phone, the internet, and the high-end computers are classified as technology infrastructure for his operations. These costs are paid directly from corporate revenue, lowering his company's taxable net income before a single dollar of tax is calculated. This concept extends even further when we look at business travel. If Julian wants to travel to Florida for a winter vacation, he must pay for his flights, his luxury lodging, and his meals using his heavily taxed personal income. But when Marcus travels, he coordinates a physical board meeting for his Wyoming limited liability company holding entity. He schedules annual meetings with strategic suppliers, real estate agents, or investment partners in that specific region. Under the United States tax code, corporate travel that is primary to business operations is fully deductible. The flights, the hotel rooms, and a massive percentage of his dining expenses are written off as legitimate corporate business travel. Perhaps the most brilliant micro-strategy Marcus employs is known as the Augusta Rule, officially structured under Section 280A of the Internal Revenue Code. This unique tax provision allows any primary homeowner in the United States to rent out their personal home to a corporation for up to 14 days per calendar year, without having to report any of that rental income on their personal tax return. The corporation, meanwhile, receives a fully legitimate tax deduction for the rent paid. This represents a complete, tax-free transfer of capital from a business entity directly into a personal bank account. To execute this, Marcus hosts the quarterly board of directors meetings for his commercial ventilation company directly at his personal residence. The corporate business rents his home at a fair market rate of $1,000 per day. Over 14 days throughout the year, his business pays his personal trust $14,000 in rental fees. The corporation deducts the $14,000 as a business expense, reducing its corporate tax. Marcus deposits the $14,000 tax-free into his personal accounts. The transaction is completely seamless, documented, and fully supported by corporate minutes and market rental valuations. But these corporate deductions are merely small pieces of the larger puzzle. The real magic of tax avoidance occurs when Marcus integrates his business profits with commercial real estate depreciation. Under current tax guidelines, businesses can write off a significant portion of the cost of heavy equipment and buildings in the very first year of purchase. This is governed by Section 179 and the bonus depreciation rules of the United States Tax Code. If the commercial ventilation business makes $500,000 in net profit, Marcus does not leave that cash to be taxed at the corporate rate. Instead, he uses that $500,000 to purchase a new commercial warehouse through his real estate holding company. He then commissions a cost segregation study. A cost segregation study is a detailed engineering report that breaks down the component parts of a commercial property into separate asset categories. Instead of depreciating the entire warehouse over 39 years, the study identifies components like specialized lighting, parking lot paving, internal wiring, and ventilation equipment that can be depreciated over 5, 7, or 15 years. This generates a massive paper loss in year one. By utilizing bonus depreciation, Marcus can claim a $300,000 paper loss on his taxes in the first year of owning the commercial warehouse. On paper, his real estate company looks like it lost a massive amount of money. In reality, Marcus has merely exchanged $500,000 in cash for a physical asset of equal value. He then uses this $300,000 paper loss to offset the taxable profit generated by his commercial ventilation company. Through this simple real estate loop, Marcus legally reduces his business taxable profit from $500,000 to $200,000. To fully understand why Julian cannot use this loophole, we must examine the passive activity loss rules. Under Section 469 of the United States Tax Code, Julian's high corporate executive income is classified as active, earned income. Real estate depreciation, however, is classified by default as a passive loss. The tax code strictly prohibits active earned income from being offset by passive losses. Julian could buy the exact same warehouse, generate the exact same cost segregation study, and yet he would be legally barred from using that paper loss to reduce his $600,000 salary. Marcus avoids this limitation through corporate structure. Because his commercial ventilation company is a flow-through entity owned by his holding company, the business revenues and real estate investments are integrated inside the same corporate umbrella. This allows Marcus to legally offset his operating business profits with his real estate depreciation, completely wiping out his corporate tax burden. This perfectly sets the stage for the final, most secure tier of quiet wealth portfolio tax mechanics on this earth. This tier is where the quiet millionaire executes the final, most secure phase of the buy, borrow, and die methodology. We have examined how Marcus buys appreciating assets and borrows against them to live tax-free. But there remains a massive, unresolved question. What happens to the debt? If Marcus spends his entire life borrowing millions of dollars against his assets, the outstanding loan balance will inevitably grow larger and larger. If Marcus is forced to pay off this massive debt while he is alive, he will have to sell his assets, triggering the very capital gains taxes he spent his life avoiding. The magic of this system relies on a biological certainty. That certainty is death. When Marcus eventually passes away, the third and most powerful step of the strategy is activated: die. Under Section 1014 of the Internal Revenue Code, assets passed to heirs at death receive what is known as a stepped-up basis. To understand this concept, we must look at how the government calculates capital gains. When Marcus originally purchased his commercial real estate and stock portfolios years ago, they had a specific starting price. This starting price is known as the cost basis. If Marcus bought stocks for $100,000, his cost basis was exactly $100,000. Over his lifetime, those stocks grew in value to $3 million. If Marcus had sold them while he was alive, he would have realized a capital gain of $2,900,000. He would have owed hundreds of thousands of dollars in taxes. But upon his death, the cost basis of those stocks is automatically stepped up, meaning the starting price is reset to the fair market value on the exact day he died. To his heirs, the new cost basis is not $100,000. The new cost basis is $3 million. Decades of compounding capital gains tax liability are completely erased in an instant. Now we can see how the outstanding debt is settled. Let us assume Marcus has $750,000 in outstanding debt on his securities-backed line of credit when he dies. His heirs inherit the stock portfolio worth $3 million, with a stepped-up cost basis of $3 million. To pay off the $750,000 loan, the executor of Marcus's estate simply sells $750,000 worth of the stepped-up stock. Because the selling price is exactly equal to the stepped-up basis, there is zero capital gain. The estate pays $0 in income tax on the sale. The executor uses that $750,000 in cash to pay off the bank, completely settling the line of credit. The remaining $2,250,000 of stock is distributed to Marcus's children, completely debt-free and completely tax-free. His children now own millions of dollars of stock with a brand new, highly elevated cost basis. They can immediately repeat the exact same buy, borrow, and die cycle. They can establish their own lines of credit, borrow tax-free cash, and pass the wealth down to their own children, repeating this loop across generations. Now let us contrast this generational triumph with Julian's traditional estate plan. Julian has lived his entire life playing by the standard rules. He has maxed out his company 401k plan and has put money into a traditional individual retirement account. Over decades, his retirement accounts have grown to $3 million. Julian believes he has secured his family's financial future. But a traditional 401k is a ticking tax bomb. It is funded with pre-tax dollars, meaning every single dollar inside the account has never been subjected to income tax. When Julian reaches retirement age and begins to withdraw money to fund his life, every single distribution is taxed as ordinary income. He must pay tax on the growth and the principal. This is not taxed at the lower capital gains rate. It is taxed at his current progressive income tax bracket, which could be as high as 37% at the federal level. But the real devastation occurs when Julian dies. Traditional retirement accounts do not receive a stepped-up basis at death. Instead, they are classified as income in respect of a decedent. This means his children inherit the retirement accounts along with a massive, unavoidable tax burden. Under current United States tax laws, specifically the Secure Act, non-spouse heirs are legally required to completely withdraw every single dollar from an inherited traditional 401k or individual retirement account within 10 years of the original owner's death. This forces his children to make massive annual withdrawals while they are in their own peak earning years, pushing them into the highest tax brackets and liquidating more than 1/3 of their family's compounding generational wealth to the government. Marcus operates in a completely different paradigm. He knows that pass-through entities and holding companies are not the ultimate endpoint. To prevent any future estate taxes or probate interference, Marcus does not pass his holdings directly to his children. Instead, his Wyoming Holding Limited Liability Company is owned by a private family trust. specifically structured as an irrevocable dynasty trust in a tax-friendly state. Dynasty trusts are specialized legal vehicles designed to last for generations, completely bypassing the standard rule against perpetuities that limits the lifespan of traditional trusts in most states. By using a dynasty trust, the assets are legally held in a permanent, sovereign structure. When Marcus passes away, nothing is technically transferred. The trust continues to own the Wyoming holding company, which continues to own the commercial real estate and the stock portfolios. Because there is no transfer of legal ownership to any individual, no estate taxes are triggered, and the probate court is completely bypassed. His children and grandchildren are named as beneficiaries of the trust. They do not own the assets, but they are granted full authority to control them. As trustees, Marcus's children can direct the trust to expand the stock portfolio, buy more commercial real estate, or borrow from the securities-backed line of credit to fund their own endeavors. The debt belongs to the trust assets, which are protected from personal creditors, divorce, and lawsuits. This multi-generational loop ensures that his lineage remains completely immune to the structural tax traps that drain the working class. This leads us directly to the core mathematical foundation. This foundation is their asset allocation system. To maintain this multi-generational compounding engine, Marcus does not simply guess how much money he can borrow. He relies on a highly structured, three-bucket financial architecture. This mathematical framework ensures that his portfolio remains completely balanced, highly liquid, and perfectly insulated from macroeconomic shocks, high interest rate environments, or sudden stock market downturns. The first tier of this system is the liquidity bucket. While the majority of Marcus's $10 million net worth is held in appreciating assets, he always maintains a highly liquid reserve. This reserve is equal to exactly 2 years of his personal living expenses, typically held in short-term United States Treasury bills or high-yield cash equivalents. This liquidity serves as his ultimate defense shield. If the public markets experience a severe drop, or if his HVAC supply business faces a temporary slowdown, Marcus does not need to draw from his line of credit or sell any stocks. He simply uses the cash from his liquidity bucket to fund his life, leaving his credit lines untouched. The second tier is the core growth bucket. This is where the bulk of Marcus's $3 million liquid stock portfolio is positioned. These funds are allocated to highly diversified, low-cost index funds tracking the broader market. This bucket is built to compound. Marcus does not pick speculative individual stocks, and he does not engage in short-term trading. Instead, he lets the compounding power of the broader global economy do the heavy lifting. This portfolio compounds silently at an average rate of 8% per year, growing his net worth and expanding his borrowing capacity without triggering annual tax friction. The third tier is the cash flow bucket. This is where Marcus positions his commercial real estate investments and his operating business equity. This bucket is engineered to produce consistent, reliable monthly cash flow. His commercial warehouse properties yield a net rental income of $75,000 per year. His commercial ventilation supply business generates hundreds of thousands of dollars in annual profit. This active and semi-passive cash flow serves a very specific structural purpose. It is the fuel that runs the entire machine. Marcus uses this cash flow to pay down the interest on his outstanding securities-backed lines of credit. By separating his wealth into these three buckets, Marcus achieves complete mathematical control. He knows that his assets are growing at an average of 8%. He knows his debt costs 6%. And he knows his cash flow from bucket 3 can easily cover his interest obligations 5 times over. This is known by corporate finance experts as a high interest coverage ratio. Because his cash flow is so robust, Marcus never has to worry about interest rates rising. Even if the Federal Reserve raises interest rates, Marcus's cash flow simply absorbs the change, while his core assets continue to compound. Now let us examine the hard truth of Julian's path. Julian is a highly intelligent, incredibly hard-working individual. He spent his entire life doing exactly what society told him to do. He went to a top-tier university. He climbed the corporate ladder. He earned a high salary. Yet, because Julian relied entirely on active, earned income, he was forced to play a game with a severe structural disadvantage. The tax code was engineered to tax his labor at the highest rates possible. The legal system exposed his hard-earned savings to predatory lawsuits. And the estate system was structured to liquidate his family's generational wealth upon his passing. Marcus is not smarter than Julian. His business is not necessarily more complex than Julian's corporate department. But Marcus understands how the system is engineered. By focusing on asset ownership instead of salary, Marcus aligned his actions with the primary incentives of the United States tax and legal systems. The government wants capital to be invested in real estate, businesses, and public equities. Therefore, the laws are structured to reward those who own assets. By utilizing corporate holding companies, asset protection trusts, real estate depreciation, and strategic debt loops, Marcus built a flawless financial ecosystem that operates in perfect harmony with the law. This represents the core philosophy of stealth wealth. Own nothing, but control everything. Marcus does not boast about his wealth. He does not wear flashy luxury brands or drive attention-grabbing vehicles. He lives a quiet, comfortable life, secure in the knowledge that his financial machine compiles capital 24 hours a day, completely shielded from the friction of taxation and litigation. Julian, on the other hand, is trapped in a constant cycle of high income and high taxation. Julian is forced to run faster and faster on the corporate treadmill just to maintain his relative position, while his compounding efforts are severely diluted by annual taxes. The lesson of the quiet millionaire is not that we must all purchase commercial warehouses or establish HVAC supply corporations tomorrow. The lesson is that we must change how we conceptualize wealth. True wealth is not measured by the size of your paycheck. It is not measured by the luxury goods you display to the public. True wealth is measured by the control you have over your time and the efficiency of the asset structures you build. By shifting our focus from earned income to asset accumulation, we can begin to break free from the earned income trap. To begin implementing these principles, one does not need $10 million today. The process begins with basic asset allocation. It starts by prioritizing investments in diversified index funds over inflated personal spending. It continues by establishing a simple, single-member limited liability company for side business operations, allowing you to utilize corporate expense deductions legally. As your assets grow, you can approach local banking institutions to establish a personal line of credit, using your growing brokerage account as collateral. This allows you to experience the exact same liquidity advantages Marcus enjoys on a smaller scale. Ultimately, the divide between Julian and Marcus is not a divide of effort, intelligence, or merit. It is a divide of pure systemic execution. While the working class is taught to trade their valuable hours for heavily taxed paper currency, the quiet millionaires next door spend their lives constructing invisible systems of appreciating assets, strategic debt loops, and private corporate vaults. They understand that true wealth compilation is not about how much money you can earn, but how much you can legally protect, control, and seamlessly pass down to future heirs through the generations of your own family lineage.